Constellation software is in one of my CoffeeCan portfolios. I actually purchased it in July of 2021, and you can see that it's now more than 10% of my Roth IRA CoffeeCan portfolio. The market value is $97.56 out of a total portfolio value of $87,000. And it's been one of my very best performers. I only own 3 shares of it. I wish I owned a lot more than that. My cost basis is around $15.30 per share. So I bought it somewhere around here in July at $15.30. So it's up over 100% since I purchased it. I wish all of my holdings could have performed this well, but it's definitely been the biggest contributor to my Roth IRA's performance over the last couple of years. Is Constellation software the perfect company to invest in? In today's video, we're going to look at Warren Buffett's definition of the perfect company and see whether Constellation software fits the bill.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
First of all, a couple member announcements. If you are on either Patreon or if you support me on YouTube as a member of the channel, this applies to you. If you're not already a member, you can sign up using the links in the description down below. And just to eliminate confusion, the Patreon and YouTube member are exactly the same. There are different platforms, whichever is your preference if you want to sign up, but it's the same content. On February 3rd, which is coming up here in about a week, I'll be releasing new CoffeeCan scorecards for the entire S&P 500 and the 66 Dividend Aristocrats. If you've been a member for at least a month and you've used the other CoffeeCan scorecards, you'll notice quite a few changes. I've made some improvements, or I hope improvements this time around. They're a lot more visual this time, so I've got all the metrics in charts. And then I'm also including some valuation information down at the bottom, so you can see whether the stocks represent a good value or not, at least relative to their historical norms. And I'm also working on a Monte Carlo simulation to hopefully include that as well. And we'll talk more about that in this video. And also on February 10th, which is a Monday, we're going to be doing another live stream. We did that in January, and it was a lot of fun. I thought it was pretty interesting and a good conversation. We'll do the same time, 2 o'clock Eastern time on Google Meet. This time, hopefully I will remember to hit the record button. And so if you're not able to make the live stream, you'll still be able to watch that after the fact. This is a comparison of Constellation Software's stock chart divided by the S&P 500. So as this green line goes up and to the right, that doesn't just mean Constellation is moving higher. It means that it's outperforming the S&P 500. And if you look here, 640%, that's not just what Constellation is up over this time. That's what it's up over this time more than the S&P 500. And anytime you see a stock that has had such extraordinary performance, chances are there is a reason for that. In one of Warren Buffett's letters to shareholders, he talks about what he and the late Charlie Munger look for in companies. He gives 4 specific criteria. The first being a business that they could understand. The second being favorable long-term economics. The third being able and trustworthy management. And D, trading at a sensible price tag. So what is it that makes Constellation Software such a high-performing stock? Is it the ideal business that Warren Buffett was talking about in his shareholder letter? The first criteria of Warren Buffett's businesses is that they should be easy to understand. Constellation Software is relatively easy to understand. What they do is buy and hold, essentially forever, industry-specific software businesses that provide specialized mission-critical software solutions. These are some of the industries that their businesses serve. For example, let's look at clubs and resorts. So if you are a golf club, for example, you're going to have very specific software needs that are not going to be met by most off-the-shelf software. So you're going to have very specific things like when to reserve a tee time or what this particular member likes to order for lunch or something like that. You're going to have all that information in the software package. So it's very specific to them. And most of these businesses are very slow growing and typically very small companies. They're very niche in the software that they provide in a specific industry. So they're not super desirable acquisition targets for a lot of big companies like Salesforce and Microsoft. They're just not going to be interested in these types of businesses. So this really gives Constellation Software an edge. They're able to get very good deals on these businesses that the founder is maybe just looking for a way to exit, or maybe the founder is wanting to stay on as a manager of the company, but they're just wanting to cash out. Those are perfect acquisition targets for Constellation, and that's exactly what they go out and buy. The second thing Buffett looks for is favorable long-term economics. And when we look at favorable economics, we are looking at the return on invested capital as the primary measure for how a management is doing at investing shareholder money at a high return. This table is from Constellation Software's financial statements. So if we look at 2008, Constellation Software's invested capital was $195 million, on which they earned $54 million in adjusted net income. That works out to a return on capital of 28%. And as they've continued to reinvest back into their business, which you can see they've done so year after year after year, they've continued to increase their net income. Basically, they are reinvesting the cash flow generated by their businesses back into buying more and more businesses, and they're getting very high returns on that investment. So in other words, think of Constellation Software as a company that's basically reinvesting your dividend on your behalf at roughly 30% per year. When you think about that, the long-term returns of the stock market are about 10%. That is very exceptional returns on capital, and they've been an absolute compounding machine. So this is the CoffeeCan scorecard for Constellation Software. Scores very highly in my CoffeeCan system, and you can see why. Just look at the consistency up here. I'm going to show you specifically the sales per share and the Warren Buffett's owner's earnings per share, which is kind of like a free cash flow method with a few adjustments made. But you can see that they have consistently grown owner's earnings per share almost every single year without fail. In fact, if we look at the median year-over-year growth in earnings per share, 12.9% per year. And their sales per share have grown a median year-over-year of 16.7%, which has naturally led to the price per share also increasing at very impressive clips. You can see the median year-over-year gain in the stock price of 32.3%. They also have insanely good gross profitability ratio, which is one of my very favorite metrics for determining whether a company has a wide moat or not. Typically, I look for companies that are at least 40%. So you can see this green line is what I would consider to be an exceptional business. They're at 68.5, which is truly astounding. Returns on capital are a little misleading. Their financial statements are a little different since they do acquire so many businesses, and the software adds some nuance to this. So free cash flow returns on capital are probably most accurate to use. So I wouldn't get too worried about this 8.7 on returns on invested capital. But by all accounts, this is a company that's been compounding shareholder wealth for decades. The next thing Buffett and Munger have looked for is able and trustworthy management. Now, this is something that I personally have underrated for a long time. I typically assume that if a business is great, it's going to remain great regardless of who's managing it. But as we've seen with businesses like GE, for example, even if you're a very great company, you can be driven to the ground by poor capital allocation and management decisions by the CEO and other top management. And when it comes to able and trustworthy management, there are very few companies with as good of leader as Mark Leonard. Mark Leonard is probably the most interesting billionaire on earth. He does not do any public appearances, or very few. He does not do any public interviews, and he did No Shave November in 1981, and he has not shaved since. But don't judge a book by its cover. Mark Leonard is a brilliant man, and if you want to get a sneak peek into his brilliance and thoughtfulness, check out his president letters. He writes them periodically. He used to write them every single year, but he started doing them more infrequently. His last one was in 2021. But I wanted to pull out a snippet that I thought was particularly revealing about this man's character and thoughtfulness. First of all, one of the things you want to look for in a high quality management is honesty. It's very difficult for most managers, especially CEOs, to be honest. They are trying to pump up, in a lot of cases, pump up their stock price so they can exercise their options. So most of the time, what they're doing is trying to increase the price per share. So they're going to give you a rosy forecast about what they expect. But Mark clearly is not. He says, I have difficulty forecasting long-term growth in Constellation's intrinsic value per share that exceeds 12% per annum. He also talks about being a perpetual owner of businesses, so caring about the long-term health of all of those small companies and providing an environment in which they can flourish. He talks about hiring high-quality managers that get compensated according to long-term incentives. Everything about his management style is absolutely perfect. What he does is buy these companies, he sets up the incentive structure to reward them for reinvesting their earnings at high returns. And if they're able to do that, they get rewarded. If they are not, then they do not get rewarded. So the incentive structure is there to promote long-term growth. And then he just sits back and continues to do what he does best, and that is allocate capital, not managing the day-to-day operations of golf court software. Finally, a sensible price tag. Now, valuation is one of the trickiest things that you can do as an investor, but it's also one of, if not the most important thing you can do. If you consistently buy companies for less than their intrinsic value, you are going to succeed as an investor. If all you do is chase the latest price trends or sell a stock just because it's down, you are not going to do well at all. So intrinsic value investing is really the only logical form of investing. And I don't mean value investing as in buying stocks with low price to earnings ratios. I mean buying companies for less than their intrinsic value. And intrinsic value is very difficult to measure. So to help me do this, I've created a Monte Carlo simulation, which is not at all perfect, but it gives me a general idea of what I might expect this particular company stock to do over the next decade, which as a coffee can investor, I am trying to hold companies for at least 10 or more years. So I'm looking out 10 or more years and trying to estimate what could the stock price be. So I've built this script to run 10,000 different hypothetical possibilities in the future, all kinds of different business environments where Constellation software grows from year to year at varying rates. So in some cases, you have extremely optimistic growth rates. Historically, Constellation's grown at 12.9% per year. However, it's possible that they could grow at a far faster rate, which they've done in some years, or if things go really poorly, they could grow at a much slower rate or possibly even shrink. So what happens if they grow at 3% per year or 23% per year? All of those are attempted to be captured within this Monte Carlo simulations. So you end up with a distribution of likely future values in the next 10 years using these long-term forecasted owner's earnings, different simulations, and then we're just multiplying that by a reasonable multiple. And the reasonable multiples are based on historics. So Constellation software has historically traded between 19.5 times owner's earnings as a low. The average has been about 25, and then the high has been about 33. So we could have a situation where the earnings grow exceptionally fast, faster than expected, and they get a high multiple. In that case, you're going to end up with a valuation that's exceptionally good. So in this case, the 90th percentile simulation was $10,000 a share. So if you bought it at today's price of $31.79, and you had a rosy outcome both in multiples and the owner's earnings growth over time, you would make 12.1% annually on that investment. If, on the other hand, things went really poorly, so your earnings were far worse than expected, and the market gave you a bad multiple, a very historically low multiple, then you could lose money on this investment. And as with any model, the assumptions are what matter most. So in this case, I've taken the 12.9% historical owner's earnings growth rate, and I've decayed that down to 6% in 10 years. Now, I personally think that's a little bit too bearish, so I ran another simulation where I assumed that the growth rate would slow from 12.9% today down to a more reasonable 10% in 10 years. And then, of course, we have the normal statistical randomness that could be different outcomes, better or worse than that. But this, I think, is a reasonable valuation estimate. So if things go very poorly in 10 years, I think you probably will get your money back. If things go exceptionally well, then I think the share price could trade for as much as $12,000 a share, which would be a 14.1% compound annual growth rate. And if things go about average, about expected, and you get about the average long-term multiple, that works out to about 7.2% return per year, plus whatever they pay in dividends. They do pay a small dividend, so you can probably bump that out to closer to 8% a year, I think is the most likely outcome for investing in this stock at this price. So for long-term investors, I do think Constellation Software is still worthy of a position in the portfolio. I am not considering selling any of my shares. I'm actually considering buying more shares. However, I think the expectations should be tempered. I don't think Constellation Software is going to grow its earnings over time at 30% clip. And I think the valuations are now to the point where most of that excellence has been priced in. So you're probably looking at more market-like returns going forward, but you have all the characteristics of what Warren Buffett calls a great business. This company has excellent management, excellent economics, and so while it may not be trading for a bargain, it's still what I believe trading at a sensible price, and that is what Buffett said he was looking for, is a sensible price tag. You're typically not going to find an elite business like Constellation Software available for a cheap price. If you are, that's when you can truly compound returns at extraordinary levels. But even at this more reasonable, not terribly undervalued price tag, I do think Constellation is still worthy of a long-term investment. Thanks for watching, and I will see you in the next video.